Join Tara and Alyssa as they explore the intersection of business, lifestyle, health, and wellness. Whether you're an entrepreneur, a wellness enthusiast, or someone seeking a meaningful life, this podcast delivers insights and inspiration for living your best life, because true success is about more than just the bottom line. To stay up to date on our latest episodes, be sure to subscribe and like us on our channel and follow us on LinkedIn or Instagram at The Business of Living Well. Hey guys, welcome back to The Business of Living Well. Today we sit down with Michael Pedersen. He is an accountant and we talk about all things finance, accounting, taxes, all the fun stuff.
Yeah, we covered a lot of bases today, from deductions and things you can do to set yourself up for the future. Also on how he balances the busy tax season with his personal life. It was a good talk today.
Yeah, and it was really beneficial for me. I have always pretty much had a W-2 job. So coming into the business world and starting a corporation and now an S corporation, it was a good refresher and just a lot of new information as well.
Yeah. I feel like no one teaches you that when you get into the business world. You just get thrown in the deep end and you're like, okay.
Yep. And that's why we
figured out. And that's why we're here today with Michael.
Yes. And we hire people to do this stuff for us.
Exactly. Yeah. So follow along with us today.
Michael Pedersen, welcome to The Business of Living Well.
We are so excited to have you. You are a tax advisor at Arrow Advisors since 2016. Almost 10 years.
Yep, that's correct.
Yep. You attended NDSU.
Yep.
You are an avid golfer.
Yep. Not great, but
some could say professional.
Yep.
And you're a dog dad.
Yep.
But most importantly, you're becoming a boy dad soon.
Yep. Soon to be boy dad.
Yay.
First one due in June. So wife and I are really excited.
So exciting. So can you share a little bit about yourself beyond that and tell us how you got to where you are today?
Yep. Yeah. So, I grew up northwest of Valley City on a little small hobby farm. We had horses growing up, so it was pretty fun. I had 4 brothers and sisters. So it was pretty crazy growing up out there. Went to Valley City High School. After that, obviously went to NDSU, majored in accounting. I love the Fargo-Moorhead area, so I just kind of fell in love with the community and have just been here ever since here in Fargo. So it's kind of a good middle spot to everything. My family's an hour west. You can get to Minneapolis quick and easy, along with Lakes Country as well. So love the area.
Did you wake up one day and decide you wanted to be an accountant, or how did you kind of figure out that's what you wanted to do?
Yeah, so not really one day. Growing up, I was just always really good at math, so I knew that I wanted to do something math related. I will say that in middle school, when they start making you take those aptitude tests, all 5 of mine were accounting related. I don't know the order of them, but it was like accounts receivable, accounts payable, tax accountant, auditor. They literally all were accounting related. So kind of from then on, I was like, well, I would guess I'll maybe do that. Then I remember my junior year of high school taking an accounting class in Valley City, and Deb Belke was my teacher in Valley City High School, and she was amazing. And that's kind of when I really started to enjoy it, and that's when I knew that that's what I was going to do. So made it easy because then I knew fairly early that's what I was going to do.
Yeah, that's so awesome. So what do you enjoy most about being an accountant and working on all things numbers?
Yeah, so I obviously love working with numbers. I enjoy it, but I really like kind of the connection I make and with my clients. Most of my business clients now, I think you mentioned since 2016, so this is my 10th full tax season, 11 if you count my internship years. So working that long with all these businesses and still being fairly young to probably be working with them for maybe another 25 plus years. I enjoy that relationship that I've developed with them. And it's been really fun to see a lot of my clients grow. They were maybe pretty small businesses, 5-10 years ago, but now they've grown pretty big. So it's fun to see that happen with people you get to know, personally. I think that's one thing that's great about smaller firms.
Yeah.
I have quite a few friends I went to college with that work at big firms, and they really like it, but you're not really working with small businesses directly as much. usually at those places, you'll maybe have 3 different people that's working on a project and only one person is actually dealing with the client, which is good too, but it's fun to actually get to work with the people directly every year and kind of help them achieve their goals and hopefully save as much tax as possible.
Yeah. You've definitely helped me.
Yeah.
That's the goal. So with, like, you help clients grow over the years, how have you seen tax advising, or like how have you seen being an accountant change throughout those years, like for yourself?
Yep. Yeah. So when I first started, pretty much everyone was coming in for a meeting, dropping off their paper tax documents. All the softwares everyone was using wasn't anything cloud-based, so they had to bring in a flash drive with any of their, business clients had to bring in a flash drive with their QuickBooks, which worked, back then, and you didn't know anything different. But now, like we have clients all over the U.S. now, and it's super easy to work with people, whether that be through, a lot of them are through referrals, but or if someone from the Fargo-Moorhead area moves away, we can still keep working with them. It's just easy now because most businesses use QuickBooks Online, which you can log into that from anywhere, instead of the old desktop version where you're putting it on a flash drive, dropping it off. Yeah. Most of my bigger clients, I actually don't really meet with throughout the year.
I was going to say, I don't think I've actually seen you like outside of our accounting stuff.
Yeah, exactly. And that's just how it is most of the time. Most of the people are, really busy themselves, both professionally and personally, where they might not want to take time out of their day to go have a tax meeting. So it's nice that you can do everything, remote essentially, where, or you can connect via Zoom or calls really easily. And whether that's, just working on your tax return, or you can plan remotely too. So you don't really need to be in person, which has helped us grow our business and our clientele, knowing that we can reach people kind of anywhere, really.
The joys of technology.
Yeah.
Makes it so much easier.
Yeah.
True.
Okay, what is one of the biggest tax changes that you've seen for the 2025 year that people should maybe be aware of? Or
So the biggest one, and there really isn't that many changes in 2025. It's 2026 where there'd potentially be a lot of changes coming up because a lot of things expire at the end of this year. But bonus depreciation is almost completely phased out. And is what bonus depreciation was where you could essentially write the whole asset off in 1 year. There still is Section 179 depreciation, which, like if you went and bought a business vehicle or business equipment, you can still write it all off anyways, but you can't have it force a loss. When bonus depreciation, you could. So that's mostly phased out right now. It's going to be completely phased out after 2025. But 1/1/2026 is when potentially we'd see some more robust changes. We'll see.
Okay.
QBI also expires at the end of this year, which that affects you guys, any small business. QBI deduction is where you get to deduct 20% of your business income right off the top and not pay tax on it. So just for quick, easy math, say you made $100,000 was your net income after expenses.
Yep.
You only have to pay income tax on 80,000 of that.
Okay.
Getting rid of it.
It's set to expire. I think they'll renew this one, but I'm not positive on that. So yeah, me too. So
Okay, back to the depreciation thing that you were saying. Is that just for vehicles then, or is that like buildings or what
so everything excluding buildings and land.
Okay.
So any equipment, any vehicles, basically it qualifies if it's 15-year property or less. And so the items that wouldn't be 15-year or less are buildings. So if you have rental properties, unfortunately, that doesn't qualify. That's the one negative thing about rentals is you have to depreciate it out over either 27 and a half or 39 years, which isn't great. But but those are more long-term investments anyways.
Okay, yeah.
Good to know.
What's one piece of financial advice that you would give everyone listening today?
Yeah, so one thing and we talk about this a lot at our firm is it's not necessarily wise to just go buy a bunch of stuff at year end to try to save tax. We have a lot of clients that obviously don't like paying tax. I obviously don't like paying tax, really. I mean, try to save as much as you can. But if there's stuff that you need, and that you're going to use, yes, absolutely buy it because you need it and you're going to use it. Like if you want to prepay for supplies or there's actual heavy equipment you need. But vehicles is one big one that we talk about a lot. Is a lot of people think, oh, I need to go buy this new pickup before the end of the year because I don't want to pay tax. But, you might buy a $50,000 pickup and save $20,000 in tax, but then you're still out the other $30,000 in a depreciating asset, when your old vehicle might have been more than adequate.
Just
If your old car isn't getting it done, yes, go buy a new vehicle. But we have some clients that buy one every single year.
So try to add the deduction.
Yeah. So, and it depends on the industry too, and the type of business. But it's really kind of just kicking the can down the road. You're deferring, which isn't necessarily great. We've seen clients more so in other industries like farming that will kind of keep deferring. But then when they're done, it all comes up and you just have a ton of taxable income that year. And then you have a ton of income in the top tax bracket. So that's one thing I always say is buy stuff you need. Because you're still out that other 70%, 75%. If you don't need it. But
I like that. Okay, what are some common mistakes that you see business owners or individuals making when they're managing their finances?
So that last one I just talked about kind of rolls into that. But another one is maybe like leaving off the table some expenses that a lot of people don't think about. We find that a lot when we take on a new client that maybe is a new business client, and we look in the past and they were never deducting any auto. That's a really common one that people aren't doing anything with. And I think a lot of people just think, my auto is just my personal vehicle. The business doesn't own it. But you can pretty much always make the case that you should be deducting at least a portion of it, as well as like cell phone expenses, home office deductions, meals when you're out with clients. We see those missed quite frequently when we bring on new clients. So really it's just, keeping track of all your deductions really thoroughly. And it also gets pretty messy. We see this a lot with small businesses is where they don't have a separate account that they're using for their business expenses, whether that be in a checking account or a credit card. Then at the end of the year, they're all stressed about getting everything together. And it's because they've got to go through whole year of business activity and personal activity all in one. So that's always a mess. It's not fun for them, not fun for us. No one's enjoying that. So that's really common. And especially like if you have an LLC set up, you should always be trying to separate, business and personal as much as possible.
What you just named a couple. Are there any other deductions that you can think of that commonly get missed?
Well, with home office, like people aren't usually keeping track of like home utilities and maybe your home insurance. And, assuming if you have a mortgage on it, you'll usually get your tax professional, your 1098 mortgage, which that has your mortgage interest and property taxes. But all those utilities that you're paying for throughout the year, homeowner's insurance, usually you can take at least a portion of that with the home office deduction. And when you think of utilities, it doesn't sound like much right away, but if you add up the whole year, when you're thinking electricity, the city bills, water, heat,
it adds up.
It does add up.
And I mean, any way to save tax is great. So.
No, have you seen such like an increase? Did the home offices increase after COVID? I'm sure a lot. And now that things are so much more remote, I know I was talking to my boss and he was like, well, yeah, like now you can work from your phone, you can work in your car, you can work from everywhere. Where like 30 years ago, you didn't work till you were physically in your office.
Yeah, that was one thing that we've seen, which has been great for people that are self-employed or that are sole proprietors or have LLCs set up, because then you can take that home office deduction. But for people that are W-2 employees employed somewhere else, there is no home office deduction for them anymore. So back in 2018, they got rid of Form 2106, which was employee business expenses. And that's where you could deduct home office, or maybe mileage that you did out of pocket, or maybe you when paid for client meals out of your own pocket, and that was the form where you could deduct that against your W-2, but they got rid of that. So
Interesting.
when COVID happened, then way more just regular W-2 employed people were working from home, and they were all that year bringing in their stuff, and there's nothing you can do with it because there's no place to deduct it. So then the IRS turned around and said that it was the employer's responsibility to choose if they wanted to reimburse, their employees for like a portion of their internet or a portion of their home expenses. But I mean, what we've seen, most employers don't do that.
Yeah, right. Say I bet not a lot of
not a lot. So that didn't really resonate with employers. So it's kind of a crappy deal, to be honest. But
well, the government always seems to come up with some crappy deals.
Yep.
How can small business owners or just individuals, how can they make sure that they're setting enough money aside to pay their taxes, especially people that don't get their taxes taken out of their paycheck?
Don't do it quarterly.
Yeah. So that's always can be a tough one at the end of the year. Usually what we say is if you put away 25% of your net income, so, that's after expenses, but usually you're going to be paying effectively like 30+% overall on everything. But then when you factor in that 20% QBI deduction that I mentioned earlier, you're not paying tax on all of your business income there. So the big portion of your self-employed taxes comes from Social Security and Medicare. So of that 25% I just mentioned, 15% of that is being paid to your Social Security and Medicare. So usually I try to tell clients that owe a bunch in that situation, at least some of it's being paid in there, but it's still not fun to pay that. But it will benefit you later, I guess, assuming that Social Security never goes away.
Right.
But that's usually what I tell clients to plan for, is 25%. It also can change too, depending on your entity structure. So if you're an S Corp, it's handled a little differently than if you're a sole proprietorship. So
you recommend just throw that money in like a savings account that can make a little interest or something? And...
I would recommend either doing that, like either savings account, or you could even do like a short-term CD that is going to mature before next tax deadline. Those are really good items, or paying quarterlies. But the one thing with quarterlies is, if you don't pay quarterlies, even if you pay by 4/15 the next year, the IRS does charge interest.
Okay.
So if you don't pay throughout the year at all, you'll still be charged some interest. It used to be not much, because when interest rates were low, the IRS interest rate was like 2%. So most of my clients didn't really pay estimates because they thought having the cash throughout the year was worth more than 2% interest. But now the IRS interest rate is up to like in the 6s. So, they count it as if you had to pay it in each quarter evenly. So you're not paying like 6% evenly on your balance due. Like if you owed 10 grand at the end of the year, it's more so like 3%. You might pay $300 of interest.
Interesting.
So I usually try to let clients know that. But it's always also based on the prior year. So there's a few formulas on how they're calculating this interest.
Okay.
Yeah.
You mentioned S Corp. What advice would you give people deciding between an LLC, an S Corp, or any other business structure? Yeah.
So it really depends, I always say, which is kind of the answer to all accounting tax questions, is it depends, but it really does. And with this, it kind of depends on your volume of income you're going to have through the entity. Usually I say if your net income is going to be 50 grand or less, then you should just have a single member LLC, because it keeps it easy, simple. You don't have to file a separate corporate tax return. You don't have to be set up paying yourself a W-2 wage. So it's just really simple. And then the least amount of overhead. And the reason why I usually use about that 50 grand is because that's usually when switching to an S Corp, the tax savings would outweigh your additional overhead. For me, it's better if you just set an S Corp up right away, because then I have a separate corporate tax return. So it's more work for us, which is, more fees for us. That's nice. But it's not best for the client until after they get to that threshold, because then they're paying us or another firm to file the extra tax returns. Either they're filing all the quarterly payroll reports themselves, or they're paying, an accounting firm to do that. And that's usually going to be, a couple $1,000s a year, depending on the volume going on. But then when you get over that $50,000 a year of income, that's where, if you're going to make, just for easy math, $100,000, you can set up your W-2 salary at $50,000 that we pay you on a base salary, and that other $50,000 you earn, you won't have to pay Social Security and Medicare. So that right there would save you probably about $7,000 in taxes and then you might only have, $2,500 of additional professional fees throughout the year. But then your tax savings way outweigh that.
Yeah.
Yeah.
Could you, this is kind of a question for myself.
Yeah.
Could you start out the year with an LLC and then switch to an S Corp, and still, what would happen then?
So you have to do it on a calendar year.
You do.
So the effect, or the change, would have to go into effect 1/1 of each year. And then that election is due March 15th of that year. So if you wanted to make that election for January 1st of 2025, you have until, the next few weeks to do that before March 15th. So you can file it by March 15th. If you want to do it, yeah, we'd have to do it before then.
We were just talking about business structures and how to structure your business. So let's hop into something fun, because that's super fun too. Yeah. But let's hop into something fun. What would be a tip that you would give your younger self for your future self now?
I wish I would have been more aggressive with investing at a younger age. I personally am invested in real estate, and I love real estate, working with real estate clients, because it's something I'm passionate about personally too. But I wish I would have started buying real estate younger. Obviously, just with how much everything's gone up in the last 8 years or so, as well as cheaper interest rates then. And then, that combined with also maybe shoveling more money into Roth accounts instead of traditional accounts. That kind of goes back to what I was saying earlier, deferring tax isn't always the best move. I started on my career basically contributing to more traditional type retirement accounts to save the tax right now. But I've kind of transitioned to Roth accounts more recently. And then also I figure too, buying real estate can never be too late for that. So started doing more of that the last few years, which I think still will be great long-term, but obviously I think would have been better had I started doing it 5, 6, 7 years ago more.
But everyone wishes that. It's whenever you start is a good time.
Yeah. It's never a bad time. And the earlier you start, the better. Exactly. So, I mean, starting it now is better than continuing to wait. So.
Yeah. You're still young.
Yeah, exactly. I'm still young. So still got a lot of time.
Can we talk a little bit back on the Roth versus the traditional IRA? So, and the tax, what's the difference between the tax there?
Yep. Yeah. So a lot of people, a lot of clients that I have love to max out their traditional plans because you save the tax right now. So, I mean, it does have a good appeal, if you're in the 22 or 24 or even higher tax brackets. If you put 10 grand in there, you're going to save roughly $2,500 in tax. So they look at it as it only really costed $7,500 to contribute 10 grand in there. While that is great, you are just kicking the can down the road. So once you pull that out is when you start paying tax on that. But then you also pay tax on all the growth. So, with a Roth account, and if your income's too high, you can't contribute to a Roth, but a lot of financial advisors here in town especially do backdoor Roth IRAs where even if your income is too high, you can still contribute to it. You just have to put it in a traditional account, and then they'll roll it over to a Roth. Don't quote me on how they are doing everything on the back end, but that's my full understanding of it. But you're essentially on the Roth accounts paying tax right now, which that's not fun. It's, you're shoveling, let's say you max it out, you put $6,000 in there, then you're also paying tax on that $6,000, which might be another $1,500. So it's less take home to you now, but then you also don't pay tax on all the growth. I mean, if it sits in there for 30 years and you're getting, 8 to 10% all that time, then when you pull it out, you don't pay tax on the growth ever. So, so that's the goal. because the money you're contributing, you're going to pay tax on that no matter what, either now or later. But it's all the growth that can happen from if you start that early. I mean, they've said if you started at 25 years old and do $100 a month, which is, not very much, especially nowadays, there would be almost $1.2 million in that account when you retire.
Wow.
Based on like historical returns. So if you're putting more in there and you're maxing it, I mean, look at the potential to grow that account.
Yeah.
And not pay tax on any of that growth.
That's super appealing. That's awesome.
Yeah. So any way to not pay tax on something, I'm for it.
Yeah, absolutely. Okay, let's talk about tax season. So obviously getting into March 15th, April 15th, how are you balancing your home life with your busy work life?
It's tough. I mean, if you ask my wife, I probably still don't balance it great, but I feel like I've gotten a lot better about it. And I think COVID actually kind of helped me with it. I never worked from home prior to COVID. I didn't have a home office. I just was always in the office. But that can get really mentally draining when you're working a lot of hours. You're in the office, 7 days a week. It's really draining when you're just coming home late at night. So I've gotten really good about coming home at a normal time, usually 6:30, having dinner at home, like at a normal time, maybe playing with my dog for a little bit, then going back to my home office and working for a couple more hours from home. I've noticed it seems like I'm more efficient too with those like evening hours. Like if I go back up to my home office and work 2 more hours, I feel like I'm getting done as much stuff as maybe took me 3 hours before, just because you're so drained being in your office that long in a row.
Yeah.
And then I probably wasn't like eating super healthy either, because you're like picking food up more frequently if you're just at the office or ordering food to your office. So it's nice doing that. And then I've tried to get really good these last couple of years about still making time for friends and family, whether that just be dinner on a Saturday night or doing something socially. Because I used to just kind of, till April 15th, just work and not really do anything.
And burn out.
It would burn you out. And then you'd get to the end of tax season and feel like you haven't seen anyone in a few months, and then you're just mentally just not in like probably a good headspace, really.
Yeah.
So I've noticed already just these last few tax seasons, really since my wife and I bought our house together, is when I started doing that more. But it's been way better, I think. I think I'm more efficient. I enjoy it more.
Is there anything that you do? You just kind of named a few. Is there anything else you do to like avoid burnout? Like, have you, like, schedule wise, is there anything that you've really kind of set for yourself to help avoid it?
So usually I try to only schedule a couple meetings a day. Like if you do a bunch of days in a row where you're like nonstop tax meetings every day, one, you don't really get an actual tax return done.
Right.
And then you get to the end of the day and it's 4 or 5 o'clock. You just finish all your meetings. Well, you don't feel like actually working, and you just don't feel like you can. So I try to space my meetings out better. And then a lot of my clients too, also from COVID, is ones that I used to meet with every year. Now maybe I'm not meeting with. So it helps me not have to cram a bunch of meetings in if we're just kind of working via email, getting everything that way. And then we've got a good group of people at our office that we all get along with really well. So even just taking periodic like 10-minute breaks and just chit-chatting throughout the day helps a lot, actually.
Clear your head, stop staring at a screen for a little
walk
bit.
Around a little bit. It's getting nicer outside, so that's better to do. Even like some people in our office like to just go outside and take a little quick walk around the block. Just then you come back and you feel way more efficient too, I feel like, and when you get back into it. So just a bunch of little things like that help. Rather than just sitting at your chair all day and just, essentially number crunching all day. So
no, I think movement's so important just to get your brain working and just move your body some. So, okay, how do you stay motivated and continue learning in an industry that does change so like every year it changes? How do you keep up with it all?
So we do continuing education pretty much every fall, because the tax code, tax laws change every year. Everything's constantly changing. But one thing that helps, I think, me and I think my colleagues stay motivated too is us personally. Like, how can we save tax personally? So
Yeah.
I kind of go into all of our continuing ed with that mindset. It's nice knowing it all so well from the continuing education to have us personally pay as little tax as possible too.
Yeah.
So that's kind of my motivation. That's one thing I really enjoy about the industry is kind of being educated in this space is good for me personally too, because I'm trying to pay as little tax as possible too, just like you and
Exactly.
everyone else. So.
I feel like that's kind of with a lot of different industries, that's kind of what stems from it. Like, you want to be better for yourself so that you can be better for other people too.
Yeah, right. Yeah, and that's the thing, like if I'm engaged in those continuing ed classes, I'm actually wanting to learn more, then I can, offer my clients more too.
Yeah. You're not just clicking through the I know, like minors.
Yeah, no, that's really common. I actually don't do continuing ed online. I go to like an in-person thing because I've done a couple online and I just, I'm working. Well, and then it's tough too when I'm sitting there. I'm like, well, I could be doing billable work with this on my second monitor.
Yeah.
So we usually, a lot of people at our office will go to in-person ones and gets you out of the office. Probably good to visit with other firms too.
Let you learn tips and tricks from each other too.
Yeah. So, I mean, really, it's like, I feel like our competition isn't really like other small firms in the area. I mean, we've noticed like everyone's busy. It seems like everyone we talk to is busy. It's probably more so like big digital companies like TurboTax or as they get bigger and bigger, that's probably more of the competition, I'd say. So we talk a lot with other firms and we have a lot of contacts that we work with throughout the state.
Yeah,
so.
I think that's such a good way to look at it for any profession, really. Like, Fargo's getting so big that there's enough business to go around.
Yeah.
I don't need to look at people as direct competitors, where I think that can be hard sometimes, but getting out and meeting them and talking to them is important, and it's good. Okay, we have a fun question.
Yeah.
If you could get rid of one tax or accounting rule forever, what would it be?
Holy cow, that's a good one. Well, I have like two answers to that.
Okay.
So one, for more of an accounting perspective, I wish that just everyone paid tax on cash basis accounting financials. The reason why is, so if you're too big of a company, you have to be on accrual basis. And that means you're paying tax on a lot of times income you haven't received yet, because you have to track like your accounts receivable, all your inventory. So if you invoiced out for a bunch of invoices in December, even if you haven't been paid on that yet, you have to pay tax on it.
Yeah.
And we get a lot of new clients that they're small enough to file cash basis and the previous firm set them up on accrual basis. And it's annoying because it's also more work for the clients, but it's also not good for the client's cash flow to pay tax on money you haven't received yet.
Yeah.
You can write it off later, but I mean, that's just not ideal. So that's probably my accounting perspective. From a tax perspective, well, I have this conversation today, and I have it with every client of mine that's retired, is I wish they changed how Social Security was taxed, because so every other retirement account, like we talked about before, Roth and traditional accounts, if you've deducted it in a prior year, you pay tax on it later. So if you contributed to a simple IRA or a traditional IRA or traditional 401k, you're deducting that now, so you pay tax later. That all makes sense. Well, Social Security, the employers all get to deduct half of it as payroll taxes. So theoretically, the most anyone should ever pay tax on is half of it, because only half was ever deducted.
Yeah.
But the majority of Americans pay tax on 85% of it. So 35% of it's getting double taxed.
Oh, wow.
Paying tax on the front end
for us.
and on the back end. So it's just, and I feel like every retired client I have brings that up. Oh, they're taxing too much of Social Security, but it really is true, and it doesn't make sense, because their rules for every other retirement plan is, that one way, and then they do this a different way. And if your income is over 40 grand when you retire, and that includes half your Social Security, then you're paying tax on 85% of it. So that's the majority of people, unless you're, literally just living on just Social Security. You have no other streams of income, whether it be retirement accounts or interest or dividends. So,
okay. So as we wrap up, we're always going to ask the same question. What does living well mean to you?
So I think it kind of wraps into both what you're doing professionally and personally. I think it's really important to have a career you enjoy, that you enjoy doing. I can't imagine working, as many hours during tax season as I do and not enjoying it at all. I mean, and there's a lot of people out there that don't enjoy their job at all. So I think you need to find something that you enjoy, but then also finding good work-life balance. As our firms have grown a lot over the last few years, I've always thought, I don't want to be working too much where I'm missing things with family and, kids on the way.
Yeah.
Financially, it's very important, but not necessarily how important is it if you miss everything. So I think it's really finding that perfect happy median where, you're working a lot, you're fulfilled professionally in what you're doing, and financially you're, you feel adequately compensated for the work you're doing, but then also still being able to, basically put work on the side and not think about it at home, which I'm probably not the greatest at it right now, but it's a, constant work in progress.
Yes. Yeah.
And then trying to be just really present when you're not at the office, whether that be vacations, and anything else just going on at home. So that's where I'm trying to find the best spot, as we continue to grow, whether that be hire more staff to help out, continually grow, but then also have a great work-life balance.
Well, I feel like that fluctuates too, of like when you don't have kids, when you don't have a wife, you can work 80 hours a week. And it's like, okay, whatever.
That's the thing. And, before I started dating Taylor too, I was just working as much as possible, trying to take on, as many new clients as possible.
Build your clients.
And grow as much as possible, which is probably the time to do it. But then you do get all those clients, and then you have to continue servicing them. But we've been good. We've hired some really good staff over the last few years too that have helped us grow. So that's been really good.
Delegate to elevate.
Yep, exactly. So that's kind of how we've been able to do it anyways. And then, then the goal too is that you're more efficient too, where maybe you're a lot more efficient than you used to be when you started, and that can help have you get done with things quicker. Maybe softwares are making things more efficient, which has been the case. So then that helps too, give you more time with friends and family, so you aren't so burned out after busy time.
Yeah, absolutely.
That was a good answer.
Sweet.
I like that. Well, thank you for coming on.
Yeah, thanks for having me. It was fun.
Great. I needed a lot of that information.
Yeah,
I should have been.
Hopefully sends you off into 2025 in a
absolutely
good note for tax planning.
Yeah, absolutely. And you'll get a follow-up email from me.
Yep. I'll be waiting.
Awesome.
Perfect.
Well, thank you.
Yeah, thank you.